This question is from Edison. He says, Mike, please help me with my position. Bought TQQ at 125.59 and bought October 9th, 140 put at 950, sold the 140 call at 3. I know you advise against a double and triple ETFs, but I really appreciate if you can shed some insights on possible adjustments. I want to continue holding beyond October 9th. Thank you so much. All right, well, first things first, let's go ahead and build this position in the custom spread tool. Normally what I do is put this into the portfolio as a collar position, but this looks more like a, I'm severely sorry, this looks more like a conversion than a collar. So I'm not sure if we'd get good rollout opportunities because we're looking at the same strikes and the same expiration date. Sorry, I already have the symbol there. We're just doing 100 shares. 125.59 is our cost. Now, okay, let's see here. Oh, good. Satish has a question as well. So Satish, hold on one second. We'll get to that as well as William. So on October 9th, I don't have the exact prices, so we're just going to currently use the market. Oh, no, you did give me the prices. October 9th, 140 put. So sort of like a near-term married put, and you bought that at 950. I'm sorry, let me do this. And then you sold the 140 call at $3. Okay, good. So we're going to buy our put, one contract at 950. Reduce the cost basis by selling the same strike call, which is going to create a straight line profit and loss chart known as a conversion. And October 9th, 140, 140. Excellent. Let's take a look and see where we are in this position. Okay, so you're at a guaranteed profit of 6% with these positions. The stock is currently trading at the same price you had meant. Oh, you said 125.59. It's only 40 cents up. Okay. So no matter what happens here, Edison, if the stock stays below 140 and you do nothing, what's going to happen? Your call is going to expire worthless and your put will be exercised. You'll sell your shares of stock at 140. You have a cost basis of 132.09. So that locks in the 791 profit or 6%. If TQQQ goes up above 140, naturally the put would now expire worthless. You'd be assigned on the call just like a covered call or a standard caller. And you'd make the 6%. So in this case, what are you going to have to do in order to stay in the position? Well, that's what happens. That depends on what happens between now and expiration. So next week, if the stock's still trading in this range, 125.99, what you're going to want to do is likely roll this put out. Your call is going to expire worthless. So what you're going to want to do is sell to close your 140 put and then buy to open a further output. You're going to roll that leg out. So I might roll it out to the 16th, the 23rd, whatever range you're hoping to hold this position for. And then you can decide after you decide which put you want to roll up to, which makes the most sense, or roll down to. If the stock's still trading at 130, maybe you want to go down to the 135, depending again on the cost and what the risk is. And if your goal is to keep this standard conversion straight line profit and loss chart or not. So I don't necessarily think you have to panic because you're not going to be worried about being assigned early on the call unless this really gaps up high on Monday or Tuesday. So right now you're still pretty far out of the money on the 140 call that you sold, which means you have the obligation. You might get assigned early, but in this case, it's still out of the money. There's no threat. Before Friday expiration, you're going to have to analyze what you want to do, excuse me, with your 140 put. Meaning that you know you want to sell to close it so you don't accidentally leave it open through expiration. And if the stock's still below 140, your broker's automatically going to exercise that for you. We may see a jump on Monday if the market recovers. We'll just have to wait and see, won't we? But that's what you want to look to do. And then you decide if you want to keep this structure, Edison, you're going to roll to a put. Why am I not saying which put you might consider rolling to? Because I have no idea where TQQQ is going to be next week. The choice that you'd make if you want to keep this collar or standard conversion profit and loss chart is going to depend on where the stock is, what strikes are available. Do you want to stay in the money in this case and not lose the position? But in order to do that just by Friday, you just have to close whichever one of these options is in the money. If the stock's above 140, your call will be in the money. You can let the put expire worthless, but you'd have to roll up the call and further out in time to stay into the stock. If it's below 140, you're going to address the put first and then decide what call to sell after you have your new structure and the other call expires worthless. Okay? Is it worth it now to roll up the 140 call or roll out the 140 call? Meaning, since the put's the one in the money, is it worth it to you now to buy to close the 140 call for October 9th and sell to open a 140 or a 145 call for the 23rd or the 16th perhaps? I don't think so. I think I would deal with the in the money option first if you're worried about rolling it, see what the new position looks like, and let whatever time value is still remaining on this out of the money 140 call still decay in your favor to next week to maximize the premium decay. Okay? That's what I would wait for. So I'm not saying which put you should roll to right now. Edison are going to run through an example because it's going to depend on where the stock is. If the stock stays where it is right now, and you can still get this sort of conversion straight line profit and loss chart, guaranteed 6% return no matter what the stock does if you leave it alone through expiration, then you could go ahead and roll to that early. But for right now, I'd like to see perhaps a little bit more time decay in the option that I'm holding that you sold for $3 so we get closer to expiration next Friday, and look to manage the put before expiration. And depending on where the stock is going to dictate if you're going again to the 140, if you're going to the 135 strikes, if you're going to the 125 strikes, depending on where the stock is and what value is available for you, Edison, to get the graph that you want, whether it's a straight line conversion or if you're going to go back into more of a standard collar position with a little bit more upside if the stock continues to move up, if that is your sentiment for the stock. So for right now, I'm just not going to worry necessarily about showing what put to roll to, because that's going to be dictated to you a little bit more by what the market's doing next week and by what your goals are on the position as well. Okay, so I'm sorry. While I'm on this topic, I'm going to cover two other questions. Now, Satish, I do have your question. I'm going to get to that in a moment. But I want to address Jerome and William real quick because it's related to the married put. And I'm going to take William's question first. Your second question, William, because it's related directly to this. William says, Michael, can you elaborate on why the TQQ married put trade works when it is so short term versus the standard married put that uses a long put expiration 5 months out? It all depends. See, you can find conversions. Conversions, William, are sometimes easy to find. Now, but sometimes they have to be further out. I have a default search here. And the answer to your question, William, is because it's a 3 times ETF and there's a pullback today, so that with the increase in volatility, that jumped up the out of the money option premiums on a 3 times Ultra or 2 times Ultra Pro ETF. So here we are in the long collar search, excuse me. And I'm going to go into conversions. It's a default search that I have where we're looking for those type of straight line profit and loss charts that might show a reasonable profit in the straight line. So here's one on RVP. Now, this here shows us that we could buy RVP at 670. And if I sold the in the money call for 190, roughly 20 cents of time premium, and I bought the out of the money November 5 put for 45 cents. Okay, so that's the natural bid in the ask. But what am I looking at here? It's showing us a net premium of 195. Where's the confusion? The confusion is because I didn't have entered here the ask price for the call and the bid price for the put. This is looking at midpoint, which likely means there's a 40, 50, 60 cent bid ask spread on the call and maybe a 25 or 30 cent bid ask spread on the put. So you might not be able to get a good enough price on the call to get a good enough price for the put, which means you might not get this locked in profit. When you see a negative max risk, that's a locked in profit. And these are somewhere 22 days out in time. So it comes down to the bid ask spread. And if you can get the midpoint, William, these conversions can work. Most of the time in a lower volatility, normal moving market, the reason why investors don't really look too much at these conversions is due to the fact that the return, now this one looks really high if you get the midpoint. We're going to look at that in a moment, William. But the returns are usually, if you're 40, 50 days out in time, 0.2% guaranteed profit, 0.3% guaranteed profit. There's no upside without management. That's it. It's usually a low return position under 1%, but a negative max risk with a positive percent return. Look at the bid-ask spreads here. We're at 190 to 280. So it's a 90-cent bid-ask spread. I bet you if I placed this order to sell the November 5 call at 235, if the market was open, William, I'd immediately see the ask price change to 235, and now the bid, the midpoint, would drop down to about 205 to 210. It'd be between 190 and 235, so about 20 cents more. This is reasonable. I'll likely get this for 40 cents, a nice normal bid-ask spread, but this call has a wide bid-ask spread. And now what would happen if I did only get 205 for this position? For the call that's $1.70 in the money, and I'm paying 40 cents for the put. That looks more along the lines of what I'd expect to see. And this is to November 20th, William. This is not a 1-week trade or a 2-week trade. You don't see many conversions that close in that are giving you anything more than a 0.1% guaranteed profit if you can find them. Okay? There's no upside without management. And when you management, what are you going to do? Buy to close the call in this case. If I wanted to stay in it, because we're selling that low strike 5 call, William, which means it's going to add back into the cost of the position, which means that now I have to roll to a different strike, so my risk reward is not going to be the same. So that wasn't really a married put trade, William. That was more along the lines of a standard collar, but using the same strike and same expiration. It creates a conversion, which is a straight line profit and loss chart. Yes, you can potentially find conversions, and that search will help you. And we can narrow this down more. If I go down here, so let's say I wanted to keep the bid-ask spread less than 25% between the bid of the call and the ask and the bid of the put and the ask. That might filter out some more of these results that have less of a bid-ask spread. But now we're 50 days, 35 days, 14 days with a 1% return on Vaxart. Vivint Solar is one as well. Assuming you can get the midpoint price, it's a big assumption. And then you'd have your straight line profit and loss chart, no risk guaranteed return position. For this one, I'd say, yeah, it probably does match your goals, a 1.1% return for 14 days. But does a 1% return, even though it's guaranteed, if you get the midpoint prices for 50 days, match your trading plan and what you're already seeing as far as returns go? I don't know. But that's sort of the difference between the conversion and the married put. The married put, I want growth. I'm going 5 months out, following the rules in the blueprint, because I want to put that time decay curve in my favor, as well as the other 3 core principles of radioactive trading. A collar, you've heard me say before, if I was going to open a standard collar, it's because I like the stock, it has good premiums. I can enter a 20 or 30-day trade that might get me a 1.5% return if I'm assigned on the call, but still control my risk to maybe 3 or 4%, or maybe a 2% return if assigned to a 5% risk, close to 2 to 1. But I still trade that with a portion of my account. It's done differently. It's a stock that I feel is strong right now, but I'm not bullish on it for 60 to 90 to 100 days. I'm bullish on it for the next 10 to 15 days, and it has a good premium where I can get the structure that I want. That's when I'll use a standard collar position, not a conversion, but a standard collar. Essentially, what would I do? Let's take American Airlines, not a recommendation or suggestion, probably wouldn't touch this, but a standard collar is I'd buy the stock at 13. If it's available, maybe sell the 13.50 or the 14 strike just out of the money call, and then buy perhaps a 12 or an 11 put. And I'm looking to have a 2% potential return, minimum 2% return if possible. Let's go to initial value standard collars here, with only taking a risk of maybe twice that. So here's a good one, though, 3% return to a 2.2% risk. That's pretty good. It's lower than 1 to 1. But in general, what I typically see is a lower return to the risk with the structure that I want to see. And that's okay. These are all still pretty good, but you're 21, 48 days out in time. I wouldn't roll this position. I wouldn't keep trading the standard collar. I'm using it as a one and done. If I get assigned at expiration and I make my 3% return, I'm done. And with that portion of my portfolio, I will look for a new standard collar trade in that case. If it ends up between the strike prices, this will help. But if this Apple position stayed between the strike prices and the call and the put expired worthless, and I'm still holding the stock, I might just rebracket the collar for the next 20 days. But if the stock falls and I get out with a smaller than the maximum risk, or I hold it to expiration and take the full risk of 2.73% return in this 21-day period, then I'm out of the position and I'm done. Okay, so we did something similar to this before, and we'll just go back clear to TQQQ for a moment. And I'm going to put that in. And we did a rough comparison. This was a couple weeks ago. And you said 125.59 was your price there. Not William, of course, but for Edison. And I'm sorry, October 9th, without the conversion factor. Now, see, these calls are highly inflated, right? Because it's a double ETF, an Ultra Pro ETF. And see, he got his call at $3 and it's already down to 130. But let's just take a look at the married put here for TQQQ. And your price on this, you got it at a different time. I understand that, but your price was at $9.50. You either legged into this earlier, or your cost basis is $125.59 for adjustments that you've done. This is why this works, William. This is what I wanted to show you. You see the option price now is in the $15 range for that 140 put. That's roughly 15, 16 points in the money. Edison got into this position. Either he's been trading this for a while and lowered the cost basis, or he did this a few days ago when the stock was at a much higher price, because this by itself is a bulletproof position. That's why that conversion looks so attractive that Edison is in, with the guaranteed profit of 6% in one direction or the other. It's not the now. What do I mean by the now? I mean, now, if I went in to TQQQ right before the close, I got near his same price. It's at 125.73. Let's say I got 125.59 for it. I'm sorry. And I bought the 140 put at midpoint, and I sold the 140 call at midpoint. Where am I going to be? I'm likely going to be at a guaranteed loss. Nope, a 0.1% return in this case. So this is something that Edison has been trading and had a lower cost basis and legged into. Using the insurance tool, perhaps he had an unrealized profit in the position, and under the married put tab maybe found the put and the call that could get him to that bulletproof status. He didn't do it right now. It's not that this position is bulletproof if we open it in the market. We're seeing a 0.1% return. Again, if we get the midpoint for that put, which might be tricky, the midpoint of the call was 131 to 137. So yeah, we can say 133 or 134. Not much of a guaranteed profit though, although we're only talking about for a week. That's why I said it might not meet your criteria, and it's under the assumption that you do get the exact midpoint to have that conversion trade, which is very difficult to do in the short term. That's why that conversion search we saw under long collars was going out far in time, 49 days, 50 days or more. Now, the reason I wanted to bring this up, this is a deep in the money put, and he's only paying about 65 cents. I'm sorry, it's a little bit more than that. So we're 125.73. So we're $14.27 in the money with a price of $15.65. So 124 is the maximum risk on this position. The time value. Now, let's say that this stock stays, TQQQ stays right at the same price all the way to expiration on the 9th. What's going to happen? Well, we're going to expect to lose about 124, right? That's going to be the maximum loss on the trade. 7 days hold time. Stock doesn't move. It will move. Volatility doesn't change. It stays at 0.81, 0.82. We're going to lose $124, or our maximum loss of 0.9% in 7 days. Now, I go out to March, 168 days out, my 5-month minimum. I keep the same 140 put, my apologies. Doubling the cost here, but what am I adding? about 20 times the amount of time. We're going on 160 days instead of 7 days. So we're going to buy this one put. And we have a higher risk of 15.6%. That's what I'd expect with a 2 times or 3 times ETF, double what we would normally look for on a standard stock with that 6, 7, 8% at risk. This makes sense. An Ultra Pro ETF is going to be double the risk because of double the applied volatility. We're going to get to that in a moment, Satish, after we cover one more slight married put topic. But what happens now if the stock stays at 125.73? The volatility stays the same at 0.9272. That's interesting that the further out volatility is higher. I wonder why. But we hold this to 10.9. Okay, so what am I looking at here? The expectation of what I'm going to lose on that far out put. I'm going 168 days out instead of 7, William, which means my time decay curve of the time value I have invested on the March option is still going to be over here. The time value decay of the option I'm selling 1 week out is going to be right here. I'm going to lose 124 in time decay in the next 7 days. I'm going to lose less than half of that, only expecting to lose about $53 total on the position in this case. Well, that includes the 14. So yeah, about $67 total on the put in this case because the decay is more slow. You have less of a loss with the longer term option in most conditions. And that's why I use the 5-month out married put instead of a 1 week out, 2 week out, or 3 week out. If I'm using something that shorter term, William, it's going to be in the collar structure, not as a straight married put. And what you were seeing on TQQQ with that bulletproof conversion, the straight line profit and loss chart of guaranteed 6%, just remember that that cost of $950 was probably much, I'm sorry, the cost of Edison's put at $950 for the 140 strike was probably because he purchased it at a different time or he had an unrealized gain in the stock already and was able to lock it in when TQQQ was at that much higher price. And it could have been as soon as yesterday as well for Edison. Let's just take a look here. Yeah, it's down 11.30 today. So when that stock the other day was up at 136, that makes a lot of sense, doesn't it? $9.50 for that slightly in the money put, about $4 or $5 in the money with a week or two to go. That makes sense. He was probably able to bulletproof. His cost basis was still 125, but when it was at 136, he was able to buy that put, bulletproof the position to no risk, and then add the call for a little bit extra oomph. Gives him that straight line profit and loss chart. Again, just to review, Edison is going to have to adjust one of those two positions, the call or the put, whichever's in the money, as he gets closer to expiration to stay in the stock. Then he will have to decide how to rebracket it. Okay, this is more of a question for blueprint owners, but I'm going to cover it really quick for Jerome. Jerome says, Mike, I have 7 open married puts at this time. 4 of those positions have a call sold against them. All 4 calls are doing really good with the market pullback and expire in 2 weeks. Is it a good idea to buy a put? I am 12 at this time and wait for the calls to expire. If your sentiment, Jerome, is that the market is going to continue down, that's when I might use income method number 12. And yes, leave the calls open so that you could potentially hedge. But you have, I'm sorry, you get more of the time decay as we just talked about for William. I'm sorry, for Edison. Now, Jerome, you have to be extraordinarily careful. I don't ever personally like using the income method number 12 approach, whether it's an earnings approach, whether it's a standard income method number 12. This is all discussed in the blueprint, the different ways to use income method number 12. More, it's discussed in the Blueprint Owners Only webinar. I am going to take Newmont Mining. And this one isn't, it's a paper trade that we did in the webinars. That's why it's negative. So let me do 2 things here. Let me drop this down to $8.65. Let me put this up to $1.40. So it's decayed about 60 cents in my favor to give us more of a reasonable profit and loss chart. Not great, but 5% risk, 1.4% return, 2 weeks out, as you mentioned. We know why the market sort of dropped today, the turmoil, and that other presentation I'm working on, we might share the first 5 slides of later, the EAP, it's the market, meaning we're in a strange form right now where we've got three major things going on. We've got earnings. We're getting into earnings season. We've got an election coming up here in the US in about a month's time. That's why it doesn't surprise me that when I looked at that TQQQ March 140 put that we analyzed for William, it's 160 days out, but the implied volatility was at 0.92 for that option. The 7-day out is only at 0.818. Why? Because the options that are coming up in the next 1 week, 2 weeks, and 3 weeks might not be affected by the earnings on the stock if it's at the 27th or 28th, and also are not going to be impacted by the result of the election. Everything after November 3rd is going to be affected. So those December, those Januaries, those Marches, and so forth, right now all have a higher implied volatility because a known event in the market with an unknown outcome is coming up. So let me just take Newmont Mining. Let me look at the stock research tool very quickly, and I see I have earnings coming up on 10/29. I'm worried about the effect of the election on my married put. If it declines, I'm worried about the earnings coming up in 10/29. That to me might be a proper use to use a shorter income method number 12, the way that I would use it around an earnings event if I'm concerned. And I'm still out to December, so it's not that far on this put. So I might consider November 6th or November 13th, and I might buy a cheap put just to give me a little bit extra. I'm going to go with the 60, and it's not that cheap because it's after November 3rd, so that implied volatility is high due to what could happen with the outcome. Now, what have I done? I've created a married put position that normally, if it was just the puts without your call, would give us a synthetic sort of strangle. In my case, I'm sorry, it'd be a synthetic November 60. Yeah, a synthetic straddle. So it would look kind of like this, and then at 60, it'd go back up. So if the stock really tanks and drops down to 55, I can be long stock and see a profit. If the stock, say, goes up to 68 or 69, I might be able to realize a profit. I'm going to need more of a move now, Jerome, for the extra cost. What's the danger of doing it when you have a call already sold? You don't get this anymore because this is capping the gain. Your risk now is to the upside. This is where you could lose 8.3% because you've added to the cost basis and you've capped the positive delta to the upside. So as the stock moves up, both puts are losing. Your call is increasing, and as you get closer to that 16-day expiration, the call delta is actually going to 1, so you have no upside gain, and 2 of the 4 assets that you have in this structure are losing value. The stock cannot gain because it is perfectly hedged by the in-the-money call. That's the danger of doing it with the call in place. Now, October 16th in my example, it's not going to be affected by the earnings. It's not going to be affected by the election. But what happens? Okay, I'm not going to say I'm expecting this to by any stretch of the imagination. But what happens next week in the markets if Pelosi, Mnuchin, Meadows get together with McConnell and they quickly pass a stimulus that's in the $1.8 to $2 trillion range for the next stimulus? Well, the market's going to go up even further than it did the other day when they talked about having a new plan in place that the House just voted on, I believe, approved, which we know probably won't get to the Senate as it stands right now. And so that puts you in a very, very risky position because you've added the extra cost with the extra put. You're not getting the advantage of the synthetic strangle or synthetic straddle position with unlimited upside and great profit to the downside if it continues to fall. You're waiting for your call premiums to do it. Any jump in there could cause you to lose money as the stock moves up because you've capped the upside with canceling the delta with a short call, and your 2 puts are going to be losing money. The idea behind the structure of income method number 12 around an earnings event or when you think the market or your stock is peaked and is going to pull back is that you don't typically have a call sold against it. So you get that sort of synthetic straddle or synthetic strangle that we're looking for. But you see again here, even just the synthetic, you need such a large move because of that higher implied volatility, because this option I selected on November 13th is going to be affected by the election. And would, in this case, also would be affected by the earnings coming out on Newmont, which we saw was the 28th or 29th. So I need to swing down 10 points, wow, to 52.85 to break even, or up to 71, another 9 points to the upside to hit the break even. And with the call that capped the upside, so your true risk, 8.3%, is anywhere above really $68, $69. Here, the max risk of 8.4 is only if the stock's trading right at $60 at the November 13th expiration, which, Jerome, is a possibility. That could happen as well. Okay, so, but you see here, the monetary risk of 8.3% on that other position was if the stock was trading anywhere above, say, $68, $69, if there was a large move. Here, I'd be at a profit at 71, 72, 73. That other structure, I'd be at max loss if there's a surprise and it really takes off. So that's why you want to graph it, Jerome, to take a look. I personally do not use income method number 12 with a short call because I don't like that structure. I don't like the shape of that profit and loss chart. It's really more of a bearish chart. If I'm that bearish, I might just wait for the call to expire, yes, but also just buy the put. But you have to be really bearish, because if it goes the wrong way for any unexpected positive event, now you're going to be losing to the upside because of the obligation of that call, the canceling of the delta. Okay. So you could do it, but at least now you see what the graph is and why I'd recommend not doing it. I don't like the structure of that trade, but yes, I hear you. If the stock starts to fall, if your anticipation is the market's going to continue down, Jerome, then you're going to get that decay in your favor, and you've got the second put in place to potentially give you that profit to the downside, but it's going to cost you a fair amount. Okay. And you could be right if it moves down. If it stagnates, though, you're still okay, but you're going to have to look to adjust that put soon, the first and the second put most likely, before it starts to lose too much time premium. Right? Because you paid into that put. If the stock's not moving, you're going to be losing time decay, which eventually is going to add to your position and increase your risk if you don't get the downside push you wanted. And if it gaps up, well, we saw the trouble there. You've had the capped gain to the upside, added cost in, so your risk is now really just starting to be anywhere above that short call strike price and beyond.